Welcome back, everyone. Today on the Joseph Carlson Show, we're going to be looking at the valuation of big tech. So Microsoft, Apple, Amazon, Google, Meta. We'll be looking over all these companies and comparing their valuation today to how they looked 2 years ago. 2 years ago, I published a video called Big Tech is Cheap. That video was very simple. I just went over the thesis of why I thought each of the big tech companies were a deal. I thought investors should buy them. And I believe that's the same for today, for some of them. So I'll be going over which ones I think are currently a deal, which ones I do not think are a deal, and the reasons why. Now, of course, we have some other news to get to as well that we'll be covering in this episode. Google is being forced to divest Google Chrome. This is what the Department of Justice is wanting them to do. They're still demanding it. And this is a big deal for Google. This is something that could potentially cause me to sell my Google shares. So we'll be looking at this news and why it's such a big deal. We also had a rumor that Apple TV Plus, Apple's TV service, lost $1 billion last year. And I'll be going over why that really isn't a big deal. We also had an interview from the CEO of Waymo saying that Tesla can't compete. They're not a competitor. And he gives his argument of why he's not concerned about Tesla competing with Waymo. And then finally, we had some news that caused a lot of rumblings on the internet, a lot of mockery, which is that DoorDash is now working with Klarna to offer buy now, pay later. To offer to buy your burrito and split it up into payments to pay it over time. We'll be going over how absurd and ridiculous this is for DoorDash. So we have a lot to get to in this episode. Let's go ahead and get started. Now we start today by looking at the valuation of big tech. These companies have come down in price as the QQQ has dropped. All the major companies, the Apples and Microsofts and Metas, those companies that are part of the Magnificent Seven have had their valuations materially get re-rated lower. And part of this, as Barron's notes, is the result of the lack of clarity on trade policy and tariffs. Now, why are trade policy and tariffs a big deal for these companies? Because these companies are massive, internationally diversified companies that earn a lot of revenue outside of the US. So companies like Microsoft and Amazon are doing massive amounts of business in Europe and all over the place. They import a lot of their goods from China. Apple manufactures from China. Amazon has tons of sellers from China. So you can see that tariffs and trade policy has a major impact on these companies. The lack of clarity has continued to weigh on Google, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. The former stars of the rally, they've all been re-rated. With Roundhill Magnificent 7 exchange traded fund finishing the week another down 0.7%. The weakness is starting to call into question the American exceptionalism trade. Quote, the new administration in Washington has created a very high level of generalized uncertainty that goes beyond trade policy itself. We now wonder whether the long-awaited great rotation out of US assets has begun. Are investors trading their money out of US companies into different markets? One upside is that the Magnificent Seven are cheaper. And they're cheaper than they've been for years. The premium of the group compared with the S&P 500 is at the lowest point since 2017. Barron points out that we're no longer paying this steep premium to own big tech. And in situations like this, when people become bearish on big tech, when they become discouraged, when they don't want to look at these companies anymore, that's typically the best time to be buying shares. In fact, another time period that investors were very discouraged with big tech, they're finding excuses to sell out of these great companies, was 2 years ago. Early 2023, I published a video called Big Tech is Cheap. And again, this is during a time period where not many people wanted to own these companies. We've just gone through years of them trading down every single week. So these were not the type of companies people were looking at that they wanted to own. Now we have the video here. It's still public. This was January 6th of 2023. And I want to highlight a couple clips here from this episode. We'll start off with just the introduction of it because I really summarized the video in a couple sentences. I think big tech is currently cheap. And I want to explain why. That is the theme of today's video. So we're going to be going over Amazon, Microsoft, Apple, Google, and Meta. I'll be doing a very quick analysis on these companies, just a couple minutes to explain with the math why I think these companies are cheap. Because it's easy to say, but I think it's good to have a reminder with actual number and data and some really quick analysis, which explains why these companies are actually trading at very discounted prices based off their future risks and future cash flows they'll produce. So we'll go through it. We'll go through all 5 of the companies. That was the summary. We start the video off. Now, one thing I did in this video as well, I'll just highlight it here, is I highlighted my total returns at the time. You can see right there, at the time, the Story Fund was in the red by $47,000. So no gains. In fact, I had massive losses in this portfolio. And I just want to highlight this because a lot of people will say, Joseph, you only highlight things or you only show your portfolio when it's in the green and you're making lots of money. Anyone that's been following my channel for any amount of time knows that I've been transparent with my gains or losses since the beginning. I have many videos like this, many episodes showing when my portfolios or my holdings were deep in the red. This one I'm down 50% money weighted. Wasn't a happy time. It was very discouraging. So coming out with a video just saying these stocks are cheap, now's the time to buy, it's harder to do that because when stocks go down and you're losing money on them, that's also a time that people don't want to listen to you. They don't want to take your advice as much. But that's the time to be buying the most, when people are discouraged with these companies. And I highlighted such at the time. In fact, I show the holdings page here. We have the holdings page. And again, I'm down $42,000 of unrealized gains, every single one of these companies. I go through them one by one. Amazon, I'm minus 42%, 22,000 in the red. Netflix, minus 31%, 10,500 in the red. So on and so forth. Google, 5,000 in the red, and more of these companies, I'm in the red. But at the time, I wasn't discouraged. I continued to build my position in these wonderful companies at discounted prices because there was so much negative sentiment in the market, so much volatility, so many investors that didn't want to think about investing at the time. That is the ample time, in fact, the best time to continue buying. And I say as much back then 2 years ago. If we look at the overall portfolio here, the performance has not been good. If I compare it against the S&P 500, this is what it looks like. The S&P 500 performance is in red. My performance of the story fund is in blue. I'll pause it there. So you can see the chart there at the time. The S&P 500 was basically flat since inception of creating this portfolio. Mine was down 25%. So I still, again, show it when I was getting crushed by the S&P 500. But I view this as the type of price you have to pay to outperform. You have to be okay with going through periods of volatility and paying attention to the fundamentals of the companies. When we look at that same portfolio today, the story fund, this is what it looks like today. It's in the green by $107,000. So it went from minus $50,000 to now plus $107,000. That's the swing that happened over only a couple years. When we look at the performance of this portfolio relative to the S&P 500, that video was right here, January of 2023. So that's what I was showing, right? It's right there. That's where it ends, 1/1/2023, just a bit past that. We have the same chart right there, hasn't changed, but now we just see a little bit further into the future. So again, when you're looking at this back in time, it's interesting to see that it could have been so discouraging. It seems like you just want to sell out of all these companies. You just want to forget about it. Your strategy's not working. These companies are no longer good because the market's telling you they're not good. Investors are selling them. People are negative. They're moody about the companies. They don't want to talk about them. That's what happens when prices go down. Price always dictates sentiment. If you can detach from that and continue to stay optimistic and look at the fundamentals of the businesses, it paints a very different picture. And that's what I tried to do in that episode. In fact, when I look back on this episode, the first company that I highlighted was Amazon, trading at $84 per share. Investors wanted nothing to do with this company. They didn't want to own it at all. So it was selling below $100 per share. I think the company right now is cheap. And when we get out to the second half of this CapEx investment cycle, I think we're going to see pretty explosive free cash flow growth. So that's my assumption right now. Amazon is cheap in my opinion. My analysis that Amazon was cheap was on the premise that this company had incredible earnings power that were being hidden by short-term investments into CapEx to build out their fulfillment network. They doubled it in size and that was very expensive. And now you see a similar thing happening. Instead of for fulfillment network, now it's with artificial intelligence. And likewise, Amazon did go from $84 up to $240, but now it's come back to $200. So it went up a whole lot. It came back a little bit, but Amazon is still over double the share price it was just 2 years ago. The question remains, is this company still cheap? And today, I still believe Amazon is cheap. I think this one is going much higher over the next 2 years. If we look at it, we have very similar concerns that we did back then. Remember, the entire reason that Amazon sold off, I do analysis on this. It's on the basis that free cash flow was terrible at the time. In 2021, it was minus $30 billion because they were doubling their fulfillment network. They were doing these big investments into really expensive CapEx that were going to pay off in the future. Anytime you do that, investors get a little bit nervous. Now we don't have the same CapEx investment for fulfillment network. Instead, we have it for artificial intelligence. And likewise, Amazon's free cash flow per share and their free cash flow is starting to trend back down. Investors are getting a little nervous. They don't know about this artificial intelligence. They want to see the free cash flows soar. They want to see a very efficient business. But Amazon does this over and over again. They aggressively make investments, large, expensive investments with a very high predictability of high returns on those CapEx investments. And I believe today it's the same situation it was back in 2022. It's going to look bad because the free cash flow is going down. Investors will be nervous during these time periods. But the investors that can see through it, that can see these investments on a longer time scale, they'll reap the rewards. The investors that are willing to buy shares at depressed share prices, below $200 per share when it trades down to $190, to pick up more shares there, I think will be rewarded. Now, I don't think that Amazon is the same deal it was back in early 2023. I don't think it's quite as discounted, but I still think it's very attractive. I still believe over the next 2 years, investors are going to see record free cash flows, record earnings per share. I would not be shocked if the share price went up another 50% to around $300 per share. Now, next is Apple. At the time of this video, Apple is cheap. Let's go ahead and take a look at my thoughts here. And I'm an Apple fanboy. I like the products. I like what they do. I think they make good stuff. But more than that, I think this stock is a good stock. I think it's actually a cheap stock currently. The reason that I say that, and I know that this one is more debatable because a lot of people think that Apple's expensive and it just won't come down in price, and they don't understand why Apple deserves this premium of a 23 forward PE ratio when 10 years ago it traded at like a 17. So shouldn't it go back to a 17 where it rightfully belongs? That's what the bears say. What the bears get wrong in this situation is that Apple today is not the same company it was 10 years ago. So you're saying a different company, the Apple today, should trade the same as it was a different company, Apple, 10 years ago. What has changed over that time? Apple has moved to become a service-oriented, subscription-oriented business that gets a ton of money from high-margin digital income. That was the thesis for believing that Apple was cheap at the time, 2 years ago. The stock price was $127, and it traded at a 23 PE ratio. Now looking at Apple today, it's gone up $220. So it's up around $100 over the past 2 years. So investors have seen huge gains, especially when you account for dividends, and Apple's PE ratio is much higher. Instead of trading at a 23, it now trades at a 29. Based on next year's earnings, or even 2026, it trades at a 27. So Apple has been rated higher. Investors have gotten on board with the software company, hardware company hybrid. The free cash flow yield is also lower. Back then, the free cash flow yield was 5.45%. Today, Apple's free cash flow yield is only 3%. So both through earnings and through cash flows, Apple has gotten more expensive since that video. So Apple will continue to grow in the future, but I don't think it's the best deal out of the Mag 7 or big tech. After Apple, I highlighted Microsoft. Let's take a look at this one, which is another company I think is cheap. I own this one in the Story Fund and my dividend portfolio. Looking at this one, the big problem with Microsoft is the forward PE ratio. That's what everybody's looking at in today's market, which I think is good, but we have to look at a couple things here. On Qualtrim, it says the forward PE ratio is based, it's a 27. Now, I go through why I believe the forward PE ratio is wrong because analysts underestimated the earnings power of Microsoft, and they did so by around 70 cents, which is a lot of earnings per share for a company like Microsoft. So they were wrong. Microsoft wasn't trading at a 27 forward PE. It was more trading at a 25. And I highlighted that Microsoft is one of the best companies in the world, that it has a credit rating better than the US government, that it's globally diversified in products and revenue segments. It's an incredibly powerful company trading at around a 25 forward PE ratio, growing above 10%. The math just didn't add up. The company was really cheap. And at the time, like you can see in this video, Microsoft was let's take a look, $222. If we look at Microsoft today, it's around double that. It's traded up to around $400 per share. So Microsoft has moved up meaningfully over the past 2 years. The valuation has also moved up a little bit from a 27 PE to a 28, but it's still not terrible. Given the growth and quality of Microsoft, I still don't think this is too bad of a deal. I could see Microsoft trading upwards above a 30 forward PE. That would be reasonable for a company like Microsoft. If the valuation expands at all, investors get both the earnings growth and the valuation expansion, which leads to a very attractive return. Now, the next one's Google, and at the time of the video, it traded at $86 per share. 17.8 forward PE ratio. Do I need to say too much more? 5.5 free cash flow yield. Okay, let's just go ahead and take a look at these numbers. Google was trading below $90 per share 2 years ago when I published this video. I say it's cheap. I say that the PE ratio is 17.8. Do I need to say more? That was the whole theme of the video. Google just obviously looked inexpensive. When we look at Google today, you notice some similarities here. The PE ratio is 18.9. So not quite at an 18, but 1 PE higher. That's not much of a change. Google trades at relatively the same price to earnings ratio it did back in that video 2 years ago, where it was below $90 per share. It went from $86 to $170. So it's appreciated a ton, but Google's also grown their earnings so quickly. The earnings have grown so rapidly that the forward PE ratio's roughly the same. That's the incredible part of a company that grows its earnings 26% per year over 5 years. It continues to be cheap even as the price appreciates. Now, the big difference in the equation is that the free cash flow yield has gone down since that video. It was around a 5% free cash flow yield. Now it's at 3.5%. This is again because these companies are investing heavily in artificial intelligence. Their CapEx lines are going up, and that's causing the free cash flow to go down. Now, I believe once again with companies like Amazon and Google that are investing heavily in AI, that it's more of a temporary thing. I believe that free cash flows will surge upwards over the coming years. Google was cheap 2 years ago, below $90 per share. I was telling investors I think it's cheap, I think they should buy it back then, and I'm telling them today the same thing. Google's cheap, given the numbers, given the valuation, given the qualities of the company, given its earnings potential in the future, the company remains cheap. The next one was Meta. This is another company that I highlighted 2 years ago as being cheap. I think that this is going to level off and stop increasing. I think the free cash flows will also start to go up because, again, the CapEx spend is going to be going down. And I think that Mark Zuckerberg got the message that investors do want him to focus on the core businesses, not just the metaverse. So he wrote a letter, he cut costs, he actually laid off some employees, and I think he's taking the company in a good direction right now. This was at $128 per share, and Meta now trades at around $600 per share, over $600. So incredible appreciation for Meta over the past 2 years. And the company today still remains at a valuation that's not incredibly demanding. It trades at below a 25 forward PE ratio. The moat of Meta continues to increase. People are addicted to their products. They're unwilling to leave, young and old. They continue to increase their family daily active people, the revenue by segment. They continue to optimize their advertising, and so on and so forth. So this is another company that even though it's appreciated a lot over the past 2 years, investors today buying Meta can expect an attractive return over the next 2 years. Out of the big tech companies that I highlighted 2 years ago, Apple's really the only one that I'm a little bit nervous about today. I'm not bearish on it, I'm just a bit more nervous on that one. The other ones I still believe are overall relatively cheap. Not quite as cheap as they were 2 years ago, but I still think they're a great deal. And many investors are nervous about them today when they weren't just a couple months ago. The valuations have come down and they're far more attractive buys. That's why I've been buying during this time of uncertainty. I recently bought $47,000 in the passive income portfolio. Google traded up from $170 to around $200 per share, and now it's come back down to where I bought into it. And even though this company trades around from $170 to $200 and back, I believe it's currently worth around $220. That's where I'd say that the current valuation is supposed to trade at. So I still believe the company is meaningfully, intrinsically undervalued today. And these are the times of uncertainty where I believe it's best to buy, when other investors aren't fully on board. When everybody loves the company and nobody wants to sell it and every institutional investor is in it, I think that's a more difficult situation. But right now, as we have all these trade policy fairs, we have all of this uncertainty, it's a much better situation to be buying these companies. Now let's go to move on to some news specific to Google. This is the news that the Department of Justice just refreshed their request. They basically just said the same thing. The Department of Justice is demanding that Google Chrome be sold from Google, that it be divested, and they may target other aspects of the business. All of this effectively means that Google may be forced to sell off Chrome, potentially sell Android, and end agreement with third parties in which Google pays to be defaulted on their search engines. Thus, court filings even suggest the final judgment should require Google to share data to offset the scale of disadvantage of its unlawful conduct that it's created. There's a lot of issues with what the Department of Justice is requiring or asking of Google to do, and I believe this is going to be argued in court for years, because the consequences of what the Department of Justice is requiring are incredibly steep. This has major implications. Just as one example, the CEO of Firefox told the Department of Justice that by removing the defaulted Google search from Firefox, it would destroy their entire business. They won't be able to operate. It makes up around 80% of their revenue. That's just one casualty from all these various changes they're requiring Google to do. And then of course there's the other aspect that the Department of Justice is not being honest in their definition of a monopoly. They claim that Google is a monopoly, that search is a monopoly, saying that it has 93% market share, but that's all of how you define a market. In reality, Amazon.com is a competitor in search to Google. People search for products and they buy them with large intent to buy on Amazon. That is a direct competitor to Google's business model. And every day there's more and more companies posing competitive threats. The Department of Justice is late to the game. There's possibly never been a time period where there's been more uncertainty about the future of Google search, with more competition invading the moat of Google search than there is today. And that is precisely the time when they're claiming this company has a monopoly. Now, this is going to be something that takes years to argue. So right now, I don't see this as an imminent threat to Google, but it's something I'm going to keep my eye on. Now, moving on, we get to the news that Apple's streaming service, Apple TV Plus, is losing over $1 billion per year to build this service, and it currently has 45 million subscribers. And they're currently spending around $4.5 billion on content annually, down from around $5 billion over the past couple of years. This is the type of news that can be startling for investors if you see this out of context, that Apple's losing $1 billion on their streaming service. That must mean that it's a failure, it's not going well, which is not the case at all. From what I've seen, all the information so far, Apple looks like it's going to be a successful streaming company. In fact, I believe they're going to be heavily profitable in just 5 years. Most streaming companies lose far more than $1 billion per year when they're building out their content library. It takes time to get a large amount of subscribers. Most companies will never reach scale. But overall, I see Apple TV Plus as a way to elevate the brand, to integrate their products into their content, to make it another reason to view Apple as more than just a hardware company, but a prestige streaming service on top of a software company. So I think overall, Apple TV Plus will be successful. It's going to be in the green by billions of dollars in the future. I think that the whole idea that streaming is a bad industry is completely incorrect. Each company that can build a successfully scaled streaming service, which I believe Apple is one of them, is going to have a very attractive business. Now moving on, we get news that the Ex-Waymo CEO was interviewed, and he had a lot to say 4 years ago about the state of technology between Waymo and Tesla, the competitive position that each company had, and he has a lot to say today. Now, he says a lot, so let's go ahead and just take a look at it here. The article title is that the Ex-Waymo CEO shares why he still thinks Tesla can't compete with Waymo's Robotaxi. In 2021, when John Krafcik was approaching the tail end of his career leading Alphabet's Waymo, the chief executive blew off Tesla as a serious competitor in the Robotaxi race, dismissing Elon Musk's EV company as an automaker with, quote, a really good driver assistance system. Shots fired. Shots fired right there. 4 years ago, he was already shooting arrows at Tesla. Those are fighting words, saying that the EV, that Tesla and Elon Musk is making a good driver assistance system. I don't think there's anything worse you could say to Tesla investors. Now you think maybe he's seen the evolution in Tesla, the presentations, the demos, maybe he has an updated opinion. Well, he does, and his updated position remains the exact same. Quote, Tesla has aspired to compete with Waymo for nearly 10 years, but they still don't. Krafcik said in an email correspondence with Business Insider, quote, they're a car company with a driver assist system. They haven't delivered a single fully autonomous revenue-generating ride yet, something Waymo is already doing 1 million times a month. More fighting words from this guy. He really doesn't hold back with his comparisons of Waymo to Tesla. So we have the CEO of Google saying that Tesla is like a big competitor. We have the previous CEO of Waymo specifically saying that Tesla is not a competitor. Now, maybe this guy just hates Tesla. Maybe he doesn't like Elon Musk and has a personal vendetta against him. But that's not what he says. He says the reason that he believes Tesla's not a true competitor is because they're not willing to use the best technology. Quote, "The cost of robust sensor sets, including LiDAR, is trivial on a per-mile basis, even more so for mapping. And the safety benefits measured in human harm reduction are real and verifiable." He says after looking at the demonstrations from Tesla that if a company were serious about building a safe and accessible robotaxi business, it would look nothing like what is shown. He says, quote, "At the moment, Waymo has no competition," later on saying they are the only company in the world successfully deploying an embodied AI replacement for a licensed human driver that can be integrated into any vehicle, and doing this at scale with third-party data verifying significant performance and safety advantages over human drivers. So he doesn't believe that Tesla is even a competitor, and they're not taking it serious because they're not using LiDAR sensors and various forms of sensors aside from just the cameras. In terms of Zoox, when he was asked about this company, which are using LiDAR and various sensors, he says, quote, that he has high hopes and appreciates that the care they are taking to get to market. He says that the bull case for Waymo is not just to have a standalone ride-hailing service, but to have a subscription service with, quote, "a guaranteed Waymo driver access," an autonomous driving software that can be deployed in large trucks and personal vehicles. So they're not going to just use this on Waymo vehicles. They're also going to license this offering to other companies, and they'll have a subscription service. This is exactly what Tesla states they're going to do as well. Waymo's trying to build out this subscription service as well. Now, there's analysts that have suggested that Waymo should be spun off, Gene Munster being one of them. I don't think that Alphabet should do this. I think they should keep Waymo. I think it's going to be so much more valuable in the years to come. They said that it could be valued at $350 to $850 billion in 2030. According to this former CEO of Waymo, he says that there's no rush. Google is fine building this business, continuing to fund it. Waymo has a deep, smart group of patient investors. There is no rush. They're not like the other wannabe AV companies tapping public markets to get quick cash to survive. Most of these companies don't have the technology to deliver the promises and will fail. I think this is one of the most significant parts of Google, one of the best stories to have for the company. They're flush with cash overall. Google has $70 billion. They don't know what to do with it. They generate more and more cash every single day, and they need growth paths, things to invest in. Here they have Waymo, this great robotaxi technology that they're building out and expanding every single day. So I'm very bullish on Google overall. I don't know how much I agree with him that Tesla's not a competitor at all. I don't really agree with that. I think that Tesla could possibly figure out how to make just cameras work. I think it's going to be harder than if they used LiDAR, but they could possibly make it work. So I'm not ruling out Tesla like this CEO is, but I think that Waymo does have a significant advantage. Now, finally, we get to one of the most ridiculous stories that I've come across over the past 5 years. The whole time I've done this is one of the craziest stories. DoorDash announces buy now, pay later partnership with Klarna. DoorDash customers can now take out a loan for a $40 order of burritos or $50 pizza delivery. The financial tech company Klarna and the delivery company DoorDash said that they have partnered together to provide buy now, pay later loan options for orders. The arrangement, announced on Tuesday, lets customers defer the costs of DoorDash orders placed online or through its app by paying it in 4 interest-free payments or at a later date. Literally now, go on and order a burrito for $20 and split that $20 up into 4 equal interest-free payments. Now, they always mention the interest-free payments. That's true. But the secret, the dirty little secret that they don't mention in all of these press releases is that if you do not pay it all on those interest-free payments, you get hit with steep fees. That's how they make the money. They sign you up and they say, hey, you can pay this over time. If you miss a payment, all of a sudden you have huge fees that you have to pay on top of it. Now we have experts like Chuck Bell, the advocacy program director at Consumer Reports, saying that, quote, buy now, pay later loans can be manageable for many people. So even though this is a little tricky, we can manage the payments of getting our burger and fries delivered to our house. And he says that you should only use this if you have the money to pay back the loans. Isn't that a novel idea that you should only use buy now, pay later if you have the money to pay for the loans? Well, I have a different take on this than Chuck Bell. I think that if you can't afford to pay for your burrito up front at the time that you're ordering it, you should not be having food delivered to your house from restaurants. That's a very simple concept, I know. And there's people that are trying to add nuance to this, finding out if consumers can pay for the installment plans on having their burger and fries delivered. But I think the obvious answer here is to not order food from DoorDash if you have to break up the payments. This is one of the situations where I read about this, and I just think that these companies don't care about you at all. It's very clear that companies like DoorDash and Klarna do not care about the consumer at all. They don't care about your health, your financial health, your well-being, what this does to you, the implications of it, how it leads down a very dark path, all of that. They will actually phrase this as a positive thing, giving customers more choice, giving them more options, more flexibility. When in reality, what they're doing is ensnaring people into payment plans and high interest rates, getting them wrapped into getting something right now without paying for it, but having the consequences of those actions later in even a more meaningful way. These companies do not care about their customer. And it's completely evident in situations like this. In fact, if you look at the data here, they highlight another important thing. If you don't pay the bill on time, you start getting multiple late fees. We already know that, but research has shown that buy now, pay later loans are more often used by people who are already in debt. So they're actually selectively looking at a group of people that can't afford to pay for the obligations they already have, and those are the very people most likely to sign up for these services, getting them in further debt. Again, these companies do not care about the customer. And these companies that are offering more flexibility, more options, this can only be looked at as predatory. The incentives are very clear. DoorDash doesn't care about how you pay for something, the effects it has on you, the interest rates you might be charged, how expensive it is, if you're already in debt and you shouldn't even be ordering this in the first place or not. All they care about is growing that top line. For Klarna, they're now targeting more consumer debt to a group of people already in debt. Both companies don't care about the people they're doing business with. They just want to grow the top line. Now, there's going to be people that lay the blame at the customer, and they're correct as well. Part of the blame is the customer that are using these type of payment forms to get their food now at the expense of themselves later. They're going to have to pay for it eventually, even if they don't have the money today. But I believe that this is a dual problem. It's a problem with the companies offering these type of services in the first place, which are completely unnecessary and somewhat predatory, and it's a problem with consumers willing to use these services. Who are using these services? Why are you paying for your burrito in installment plans? There's just no excuse for it. If you have to break up the purchase of a DoorDash order into 4 installments, you should be working for DoorDash. You should be out there driving DoorDash orders trying to earn extra money. You certainly shouldn't be the one purchasing from DoorDash. DoorDash in and of itself is an enormous waste of money. I know, I've used DoorDash a number of times, and every time I use it, I can see how much money I've wasted. I feel a little bit of regret every time I order from it. But even as I order from DoorDash, I think that I would never do this if I couldn't afford to pay for it up front. That is a whole different category. Breaking it up into payments, trying to pay for your food being delivered over a period of months is insane. And it should be called out as being insane. This news is insane, and it's one of the most egregious, biggest examples of corporate greed, consumerism, laziness, and indebtedness that I've ever seen. You have all of that mixed together in a single headline that you can buy your burrito in 4 payments. That's all for this episode. See you in the next one.